tourist stands in front of a street vendor in Tokyo, staring down at a bowl of ramen that costs nearly twice what it did back home. Same bowl, same noodles. But the price? Ouch. Why? The answer isn't just about the restaurant or the cost of imports. It's about the Japanese yen and how weak it's become. Now flip the scenario. A German engineer exports machinery to the US and watches his profits balloon. Not because he sold more, but because the euro dropped against the dollar. Suddenly, his goods are cheaper abroad. This isn't just currency fluctuation, it's strategy, and sometimes it's deliberate. Today we're digging into a question that seems backward at first. Why would a country want a weaker currency? Isn't a strong currency better? The truth is more complicated, and it has everything to do with power, jobs, exports, and in some cases, survival. Let's break it down. To understand why countries might actually want their currency to lose value, we need to get clear on what a weak currency does. In simple terms, when a country's currency falls, its exports get cheaper for the rest of the world. Imagine a US company buying parts from South Korea. If the Korean won drops in value, suddenly those parts cost less in dollars. US companies love that. It lowers costs and boosts profit margins. Meanwhile, Korean exporters win too. Demand for their goods goes up. So, a weaker currency can make a country's products more competitive overseas. It's a classic lever for boosting exports, helping manufacturers, and in turn, supporting jobs. That's a big deal for governments trying to stimulate economic growth, especially when other tools like interest rate cuts have already been maxed out. But there's a flip side. A weaker currency also makes imports more expensive. That bowl of ramen in Tokyo, that's inflation imported straight into the country. Energy, food, tech, anything brought in from abroad costs more. So, the gamble is this. Will cheaper exports help the economy more than pricier imports hurt it? Let's look at Japan, where this story plays out in slow motion. Since the 1990s, Japan has wrestled with low growth, low inflation, and at times, even deflation. Its central bank, the Bank of Japan, took extreme steps to revive the economy. Near-zero interest rates, massive bond buying programs, and an ultra-loose monetary policy long before it became fashionable in the West. One side effect? A consistently weaker yen. At times, this seemed intentional, and in many ways, it was. By keeping interest rates low and flooding the market with yen, Japan effectively made its currency less attractive to foreign investors. The result? The yen depreciated. That helped Japanese exports, like cars and electronics, stay competitive abroad, especially against a strong US dollar. But this wasn't without cost. Japan imports nearly all its energy. A weaker yen means higher fuel prices, which hit households hard. It also reduces Japanese purchasing power abroad. Bad news for travelers, students, or businesses relying on foreign goods. Still, the government and central bank made a call. Better to help exporters and lift the broader economy, even if it meant some pain on the import side. It's not a popular choice, but it's been part of Japan's playbook for decades. China, too, has long been accused of keeping its currency weak, though in a more direct, hands-on way. For years, China tightly controlled the value of the yuan, keeping it low against the dollar through strict capital controls and direct intervention in currency markets. The goal? Supercharge its manufacturing sector. A cheap yuan meant Chinese goods were dirt cheap on global shelves, especially in the US and Europe. This fueled an export boom that lifted hundreds of millions out of poverty and turned China into the world's factory. From toys and textiles to smartphones and solar panels, low prices made Chinese goods dominant. Critics, especially in Washington, called it currency manipulation. U.S. officials argued that China was gaming the system, creating unfair trade advantages and hollowing out American industry. The accusations became a flashpoint in the U.S.-China trade war, with tariffs and countermeasures flying back and forth. China eventually loosened its grip on the yuan, partly due to external pressure, partly because it was shifting toward a more consumer-driven economy. But the legacy remains: a long-term, intentional strategy to grow by keeping its currency cheap. Now, let's take a more complicated example: the euro. Unlike Japan or China, individual countries in the eurozone can't control their own currency. They all use the euro, but the European Central Bank sets policy for the entire bloc. That makes things tricky. Take Germany. It runs trade surpluses year after year, exporting high-end machinery and cars across the globe. A weaker euro helps those exports, but Germany doesn't control the currency. At the same time, countries like Italy or Greece might benefit even more from a weak euro to boost tourism or local manufacturing. But they also have no direct control. They're stuck with ECB policies that reflect the broader needs of the eurozone. This creates tension. Some economists argue that the euro's value is too low for Germany and too high for weaker economies, like Portugal or Spain. The result? Germany gets an export windfall. Meanwhile, Southern Europe struggles with higher import costs and limited monetary tools to compete. It's a classic case of one-size-fits-all, not fitting anyone perfectly. So, where does the United States fit in? The US dollar is often strong. It's the world's reserve currency, used in everything from oil deals to foreign debt. That gives the US enormous power, but also a unique problem. A strong dollar can hurt American exporters. Think about Boeing competing with Airbus. If the dollar surges while the euro drops, Boeing's planes suddenly cost a lot more on the international market. That can shift contracts, cost jobs, and strain local industries. It's one reason U.S. presidents across parties have occasionally grumbled about the dollar being too strong. But unlike China or Japan, the U.S. doesn't directly intervene to weaken its currency. It relies on the Federal Reserve, whose job is to manage inflation and employment, not to game the dollar for trade advantage. That said, when the Fed raises interest rates, it often strengthens the dollar, attracting capital from around the world. So, while the U.S. doesn't chase a weaker currency, it sometimes pays the price for having a strong one, especially when it comes to exports, tourism, or foreign demand for U.S. assets. Now, here's where it gets dangerous. If one country weakens its currency to help exports, others might follow. This is what economists call a currency war. Everyone tries to devalue at the same time, hoping to out-cheap their neighbor. But it's a race with no winner. Eventually, you get instability, inflation, and a breakdown in trust between trading partners. We saw flashes of this in the early 2010s, especially after the global financial crisis. With interest rates near zero, central banks from Japan to Switzerland to Sweden slashed rates further, even into negative territory. They printed money, they expanded balance sheets, all to stimulate growth, and yes, weaken their currencies. The result? Tensions, accusations, trade frictions, and in some cases, massive capital flows that destabilized emerging markets. This is why international institutions like the IMF discourage competitive devaluations. It creates more volatility than growth, and usually ends in political fallout. Let's be clear, not every weak currency is by choice. Sometimes a currency crashes because of crisis, not strategy. Look at Argentina. The peso has lost more than 90% of its value over the past decade. That wasn't a plan. It was a symptom of inflation, debt defaults, and broken trust. In Venezuela, the bolivar became so worthless, people used it to make crafts and wallets. Turkey offers a more recent example. Years of economic mismanagement and political interference in the central bank led to a plunging lira and surging inflation. The government didn't want a weak currency. It couldn't stop it. In these cases, a weak currency means chaos. Savings evaporate. Imports dry up. Inflation soars. People lose faith not just in money, but in institutions. So while some countries aim for devaluation as a tool, others suffer it as a consequence. There's a big difference. A weaker currency can be a tool or a warning sign. For some governments, it's a lever they pull to boost exports, protect jobs, and keep factories humming. For others, it's a side effect of deeper problems: debt, instability, or fading investor trust. Either way, the value of a currency is never just a number. It's a reflection of how the world sees a country, its economy, its leadership, and its future. And that makes currency policy political. When a central bank cuts rates to stimulate growth, it's also shifting the global chessboard. When a finance minister talks down the national currency, they're sending signals not just to markets, but to workers, voters, and trading partners. It's not just economics, it's geopolitics, wrapped in decimal points. Today, the battle over currencies hasn't gone away. It's just moved into a new phase. With inflation still lingering in parts of the world, interest rates are high. That's strengthened the US dollar again, pressuring countries like Japan and South Korea to respond. Meanwhile, emerging markets are stuck in the middle, trying to keep their currencies stable while avoiding capital flight and soaring import costs. And then there's the next big question. What happens if the dollar's dominance fades? Some countries, like China and Russia, are already trying to settle trade in their own currencies. Others are exploring digital currencies issued by central banks. If those take off, it could reshape how currencies compete and cooperate globally. But for now, the fundamental tension remains. Strong currency equals more buying power, but weak currency can mean more jobs. So, the next time you see headlines about a falling yen or a rising dollar, know this: it's not just financial news. It's a tug of war between nations, a strategy to grow, and sometimes a desperate move to survive. Thanks for watching. If you found this video thought-provoking, consider subscribing. We tell these kinds of economic stories not just to explain the world, but to help you read between the lines of what's really going on. Because money isn't just money. It's a story of power, trust, and the choices nations make when the stakes are high. See you next time.